Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 192nd VideoCast, 182nd podcast for the week ending June 22nd, 2023. Quick public service announcement. I'll be on Yahoo Finance again tomorrow morning at 11 a.m. with Shauna Smith, so you definitely want to check in for that. It's a new format. I'll be on with the chief global strategist from Invesco, with Shauna Smith, with John Gagliardi, who you may remember from Fox Business. I've done many segments with him, so it should be a fun morning. Check that out at 11 a.m. Also, want to thank Catherine Myers, Cheryl Cassoni, and Liz Clayman for having me on the Clayman Countdown this week to talk China developments and which sectors will outperform into year-end and a new pick. So we're going to listen to that right now.
There. Tom Hayes, I want to stay on China, though, because obviously there's a lot of talk, of course, about economic partnerships. We know that Xi Jinping met with Bill Gates last Friday before he even met with Antony Blinken. Elon Musk recently came back from China, Jamie Dimon, China. That relationship and what you heard this morning from the two leaders, what do you make of it, and does it impact how you invest right now, Tom?
Yeah, Cheryl, well, I think this is a step in the right direction. We'll compete vigorously where it makes sense, but we'll also cooperate where it's in our best interest. And I think Xi came out and said that progress was made and they've reached agreements on certain issues. They were pretty vague about which issues. Blinken called it candid and constructive. So you have the positive news on that front, and you have the negative news. Goldman cut GDP from 6% to 5.4%. because they're worried that the stimulus is not going to be aggressive enough. We do think that the stimulus will be aggressive in the back half. They did cut short rates last week. They are going to do more moving forward. But what you really need to keep in mind, Cheryl, is that emerging markets in China is basically a currency trade. And if you remember, the US dollar really rallied aggressively into those debt ceiling talks. And once that was resolved in the last few weeks, the dollar has been weakening again. It's resumed its downtrend that it started in October. And companies like Alibaba have been up 18% in the last few weeks. So we think on a relative basis, if you look at all the gains in the United States year to date, a lot of them were driven by big tech. We actually think the relative value trade for the second half of this year, with the dollar resuming its downtrend, is going to be in emerging markets and some Chinese tech like Alibaba, et cetera, that have really been beaten down. They've done nothing for 12 months, but we do think we're going to see that back half recovery on a relative basis.
So you're not concerned about kind of this cooling relationship between the United States and China? I mean, you're willing to make that trade and do the investing. I think that's interesting. You know, you also talked, Tom, about catch-up stocks. You mentioned the rally with technology, with the NASDAQ. I think, the S&P is up 16% year to date. What are the catch-up stocks that you're talking about, Tom?
Yeah, I think you got it exactly. What you saw was the bulk of the rally up until about a month ago was driven by the Magnificent Seven, those big tech stocks. 93% of the S&P had about 0% returns year to date up until about a month ago. So as the dollar resumes its weakness, what we're going to see is benefits from multinational companies who get more than 50% of their revenue from abroad as the dollar weakens. So think Intel gets 82% of their revenues abroad, 3M 49%, PayPal 47%, VF Corp, stuff like Stanley Black & Decker, et cetera. So we think those companies, the emerging markets, and biotech as risk comes back on. And we've got a couple of stocks here that are down 80% since their pandemic highs that also offer value. One of them is PayPal. People are worried about the competition for PayPal. They get just about half of their revenues abroad. They've got 435 million users, 22.3 billion transactions. And we think a lot of the bad news is priced in, a lot of the fear. It's now trading at 11 times forward earnings versus 33 times average. So we think there's a lot of value here as they get a new CEO and as Elliott Management has been active in the stock.
I was going to ask you about your stock picks. You beat me to it. Stephen Short.
And we're back. So that gives you a little overview. Also want to thank Shubham Batra and Shrishti Akkar for having me in their article on Reuters today. We've got a lot to cover today, a lot of Ask Me Anything questions, a lot of data to go through. So we're going to go in kind of warp speed here and move right along. A couple things. We were down in Ocean City, New Jersey this weekend for the Open Water Mimi is just turned 11 last week, and she swam a mile open water. It was absolutely unbelievable. She came in 4th for the whole East Coast Championship, but it was 14 and under. So the people ahead of her were 14, 13, and 12, which is unbelievable because we're very, very happy for her because now she's found her spike, she's found her lane, and she can really take a path to greatness here. Annabelle's always been a sprinter, and she's rocking it, but really excited for Mimi and also crushing it in water polo. So we're excited about that. And moving right along, the turtle came back this week. If you remember from last week, the turtle was blocking the driveway. Well, he came back for more, and apparently my Asian friend followers say that's good luck for Alibaba. We'll see. A few more birthday pics. They got to celebrate twice. We had the big party a week before, and then this week, and these are some cupcakes from Grandma, and then all their presents scattered everywhere. This was Father's Day. Really couldn't have been any better of a day. Really enjoyed that. And then this was the Eastern Zone Open Water Championships. So you can get a sense. They had to swim all the way around these buoys, and they have people. This is the bay. This is salt water. They have all these people on surfboards and jet skis because not everyone makes it the full way. And here's Mimi warming up on Saturday, the day before the race. There's the jet ski people with all the teenage boys, and she kept up with them with no problem, which was awesome. And then we dropped by my parents to drop off the dogs for the day, who are still up in New Jersey. And if you think you have to be born with a silver spoon to do well in this business, think again. Here we are at the Ridge Diner. I grew up going to there late nights on, I guess, Fridays and Saturdays as a teenager, and they've renamed the main street James Gandolfini Way. That's from The Sopranos. He grew up in the same town that I did, so maybe there's something in the water. But moving right along, want to get to this research from Michael Hartnett, one of the best at Bank of America. He's talking about ex-U.S. equities, global world equities, rest of the world stocks minus U.S. versus global bonds is breaking out after 15 years. And this is indicative of the underperformance of emerging markets during that period. And now that's breaking out. This is a regime change that we're well prepared for. We've been talking about, but he's acknowledging it here. And he's saying lower U.S. dollar is bullish for inflation assets, commodities, international stocks, particularly emerging market, as China, India, and Brazil ease policy in the second half of the year. And we couldn't agree more. Amen. Hallelujah. Let's rock and roll here. So all the pieces are coming together. I want to go through a couple more important charts that he listed here. Total stock allocation versus Bank of America Fund Manager Survey. Overweight equities. So you can see here still, this is as of Friday, ladies and gentlemen, you can see that the underweight equities in the fund manager survey for international managers, they're the most underweight since this check back in early 2009, which was the bottom of the market. So this is kind of generational buying opportunities, not chasing the index, not chasing the things that are already up 50%, but all the stuff under the surface that's going to be up 30, 50, 100% before the end of the year. And even if the big names perform less well than they have the first half of the year. It doesn't mean they have to crash. It just means that it's time for the other 90% to step up, which has started to happen already in the last month in spades. Individual investor sentiment is starting to perk up. We acknowledge that. Here is the U.S. dollar. Weaker is bullish for inflation assets, and he's showing how this could break down here through this long-term trend. Also, China's easing policy equals a boon for emerging markets versus U.S., and he's showing the China 10-year government bond yield, and you can see every time it got this low were monster rallies in Chinese equities off these lows, and that's what we have right now, which is very stimulative. If you think of rates up in the U.S., think of rates and tightening in the U.S., and policy tightening and less spending. In China, it's the exact opposite on all fronts, which is constructive for equities. I know people don't feel it right now, but don't worry. When the price goes up, you'll start to feel it, and everyone else will start to feel it, and then they'll chase up. and we've gone through this over and over. So, also shows that during the Spanish flu era was also impervious to monetary policy. This was the unemployment rate, so it showed that quick spike up and then the rollover, and similar situation that we had in COVID here. The other thing that I wanted to show you was the bull bear indicator that they use. Well, here's performance year to date by asset class. I like to cover this when we can. We always talked about the last shall be first. REITs have started to come off the mat. They were negative 25 last year. They're positive so far. We still have the second half. Emerging markets were the second worst. They're now the third best at 7.3%. S&P was the third worst. Now it's at the top spot year to date. Even European equities, now they're at the top spot. Last shall be first is working. Gold was terrible 2 years ago. It was good last year. Is okay this year. So I think there's more room for REITs. I think there's more room for emerging markets, and that thesis holds. So, and here's the bull bear indicator showing it's nowhere near extreme bullishness when you look at the compilation of all the things that they're talking about: hedge fund position, credit market technicals, equity market breadth, equity flows, bond flows, and positioning. Shows us that there's a lot more to go before we're at euphoria. We agree. Here's from RBC, some charts just to give you a bigger picture in what's happening. You don't top out at stuff like this. You work higher, and working towards those 48.18 highs, which is pretty exciting to see. You know, when we were pounding the table in October saying if you're not buying equities here, find another vocation, and all the big hedge fund managers were saying that we're going down another 20% and earnings have to come down and blah, blah, blah. It's amazing. All these people are still on TV every single day. It's mind-boggling. But because negative sells is really what it comes down to. But moving right along, this is looking constructive across the board, you know, and these resistant levels are higher, not lower. NASDAQ, same thing. As much as it feels like you've gone straight up, there's a lot more work to do to press higher. Even the Dow is looking like it can break out here. Russell is what I'm most interested in as the laggard. I think that can start to get bid in the second half of the year in a material way. That's largely a regional bank and some energy trade. I think that's going to start to get bid again selectively. The sentiment we've already covered. The 10-year yield, that's obviously topped out here. We're waiting for it to start to revert. But keep in mind, they're issuing $1 trillion of treasuries in the last, since the debt ceiling deal through July. So those yields aren't going to come down immediately. But I think July, August, you're going to start to see massive compression, which leads right into our thesis of interest rate sensitive in the back half. Banks will do better as their loan books go up and their assets go up and their balance sheets improve due to the 10-year getting bid. And their funding costs stabilizing as well with the Fed being out of the market. This you can see here is a downtrend in the 10-year yield. We think this will roll off once they get that big issuance of $1 trillion out of the way. U.S. dollar, it's in a downtrend here. We're going to look at some commodity stuff here, which will be good for emerging markets. And oil looks like it's probably putting in a short-term bottom here for driving season. Then you got natural gas, same story. Copper, same story. That's a China proxy. That looks constructive. We went through the sectors, I think, a couple weeks ago, so we'll not spend time on that. But you can see even these quote-unquote overbought stocks. I mean, Microsoft looks like it's ready to break out to new highs. I mean, that's mind-boggling. Apple, same story. I mean, it's like, yeah, they've gone a lot, but, NVIDIA already did, and I think some of these are going to follow. We own Google here, so it's at resistance. That should probably start to break higher. Amazon we have. That should continue to break higher. As a matter of fact, it was up pretty big today. And I think that's it for this slide. As always, want to thank my friends Adam, Rick, and Zach for getting me just incredible research. You guys are awesome. I thought this was interesting. This guy is usually very, very negative on everything, but he puts out some good charts, and the one thing that I love is this Brazil chart, which is making me more and more interested. I mean, it's going to be basically the same thing as the China trade, but he's showing that Brazilian stocks are historically cheap with a total market cap that's approximately 50% of its money supply and less than 35% of its GDP. Previous instances of such low valuations have presented excellent long-term investment opportunities. To provide context, the overall market cap of the U.S. equities today represents 216% of its money supply and 156% of GDP. Despite concerns among certain investors regarding the current political leadership, Brazilian markets have consistently outperformed U.S. equities in the last couple of years. I don't know if that's true, by the way. But anyway, the rest of it is correct. Brazil's macro and fundamental case is compelling, and this is likely the beginning of a multi-year trend. We agree. We're probably going to start to look more aggressively there. I mean, we won't miss anything because we have enough emerging market exposure, and it's all the same basic currency trade. But I think it's time to get one or two big names in Brazil and stop sucking our thumbs on that. Here's from Ryan Dietrich. When the S&P is up between 10 to 15% year to date at the end of June, the rest of the year has been higher 12 out of 12 times with a median of 11%. Good stuff. Strong first half usually means a strong second half. And what he's saying here, final 6 months, same exact thing. This is Seth Golden talking about Amazon. Since 2008, when Amazon had a negative return year, the stock was able to hit fresh all-time highs in the following calendar year. If that turns out to be true this year, that will be a huge contributor. Long way to go to 170s or lots of profits to achieve to the 170s. We'll see if that plays out again. I wouldn't be surprised at all because of generative AI, the cloud, all the reasons that we're in Alibaba. It's just the US Alibaba is all it is. Boy, that would be something. So very astute observation there from Seth. And then he pointed to, as previously mentioned, selling may go away wasn't ideal if the analog holds true. This is the composite cycle from Ned Davis Research for the third year of the presidential cycle. And, we're basically just getting going. So the implication is you should have a continuation of the rally through July, and then you get that sideways chop once you get everyone in off the sidelines. And we think that's true, which would imply that the mega cap techs will start to underperform the second half of the year while everything else starts to perform. The indices go sideways, and the magic is under the surface, as we like to say. So, most investors are still trapped in the 2020s bear market. About half of survey respondents describe themselves as bearish, with many saying they expect a recession in 2023. This is a Goldman survey of 900 institutional clients, and this is as of today, ladies and gentlemen. This is unbelievable. Talk about a wall of worry. They've laid so many bricks. It's unbelievable, which means we could push higher. And they're not going to flip until they have to at 48.15, which is just sad for them. A lot of people are going to lose their careers buying into the bearish narrative. And before they know it, they're going to say, oh, we didn't realize earnings were actually going to recover. If we'd known that the E was not a static number and it was actually a dynamic number and we paid attention to earnings estimates going up and not down, maybe we would have caught it. But instead, unfortunately, none of you shared my podcast with them. And they're in that sad state of affairs. I'm kidding, but that's the state of affairs. PayPal expects $5 billion in buybacks following the deal with KKR. We pitched PayPal on Yahoo last week. Jumped since then. We think this is an undervalued stock. We think that all the fears about domestic competition with FedNow and Apple Pay are overblown. Apple Pay is a different game. Maybe it competes with Venmo, but they haven't been able to monetize Venmo anyway. As far as their conversion online, PayPal checkout converts at 90%, whereas a regular checkout from any of the other vendors' payment processor converts at 50% online. And then, as we said, even if they lost 100% of the U.S. revenue, which is not going to happen, it's actually growing, it's still undervalued on the basis of the international, and then you get a weakening dollar and that goes up. So we continue to like that one. 3M's juicy dividend may well get cut. No, you know what, Sherlock, like where have you been, living under a rock? The stock is down. This is one of the best quality businesses in the world, down 55%. You think that's not priced in. Now you could say, no, it's not, because usually when they announce the dividend, you get a final flush. That could certainly be 100% accurate. But the thing is, you got asymmetry. Okay, so let's say worst case scenario happens and they got to pay out $30-40 billion for all these lawsuits, which I think it's going to be half that. But let's just say that takes place, and they got to cut 100% of the dividend. Now, there's also Thesis. They could borrow $30 billion and then they don't have to cut the dividend. let's just say they cut 100% of the dividend, which is our base case, by the way. Then you've got a business that compounds capital at 20% a year, that pays no dividend, but still compounds capital at 20% a year, and you're paying 10 times earnings. So tell me what's wrong with that. And then if you actually get a positive outcome and they don't have to cut the dividend, well, then the stock is, undervalued by 50%. And that's scary. So the way I think about it is, if they announce the dividend cut, most of that is priced into the 55% drop. So maybe it went from 100 to 80 for a few weeks because everyone panics out of it, and all these dividend aristocrat ETFs puke out the stock because it's no longer increasing its dividend like it has for the last 63 years. So you get a flush down at 20%. I really don't care. If I'm buying a business that compounds at 20% a year, whether I buy it at 8 times earnings or 10 times earnings, when I look 3 years out, I still got one of the best businesses in the world with the research and development moat, with the compounding moat, with the coming out of COVID moat, with the inventory destocking tailwind, and all these things. So the only question is, am I getting a 6% dividend, or am I getting a 0% dividend? And to me, it really makes no difference. But here's the thing. If they don't have to cut the dividend and you don't get that flush to $80, well, then you wake up one morning with a settlement and you can't even get in at $130 or $140, and you're toast, and you missed one of the rare opportunities to buy one of the greatest businesses in the world. So you have to take the asymmetry, and that's why you can't have 50% of your wealth in one stock. I mean, you can have, I think this is a 5% position for us, and then a little bit of kicker with the derivatives, but so we get notional more, and we can really juice it as we get the double. It turns into more than that. But this was a little bit lightweight written, because it was this guy from RBC that we've talked about who basically downgraded in the hole in $92 and then has been panicking every day since it went up to $104 and trying to talk the stock down because he downgraded it at the absolute low. And I think he's going to get his face ripped off. But, maybe the opposite will be true. But I'm comfortable with it. Like, if they cut 100% of their dividend due to a worst case scenario, I'm investing on the basis of that worst case scenario going in. So if I don't get the bottom tick of it, I don't care, because if that worst case scenario doesn't play out, there will be no bottom tick, and you'll be chasing up at 130, 140. So that's my view. This gentleman, Josh Nathan Kazis, put out this article, 15 biotech stocks Wall Street analysts say are too cheap. So he's basically showing how all these companies are trading cheaper than net liquidation value, and that the conditions are starting to improve, and he's bullish on the XBI. We couldn't agree more, so you can read that on Barron's. China stimulus calls mount from state media top advisors. So 3 state newspapers run front page articles on PBOC easing. Communist Party's official says consumption is the key for growth. So I think now, the stocks were down this week because they were expecting this big package to come out with property and all that stuff last week, and a bigger cut, and it didn't happen, and the markets got into a tizzy. It is what it is. We've waited long enough. We can wait another couple days or a couple weeks. It's not the end of the world. Insiders snap up auto stock in auto parts retailers. I think we talked about Advanced Auto Parts in recent weeks and some of these others they're buying, so I thought that was interesting. And then a couple weeks ago, we covered Bud, and one of the reporters had called me, and I said on this call that, leaving politics aside, the U.S. impact of Bud Light represents 2% of their global revenues, and the stock was down, I don't know, it was like 30 or 40% on the news. This is probably overdone, but we don't love the business, so we didn't take any action on that. But we laid out the case, and now it looks like another analyst saw what we saw when they actually did the math versus dealing with the nonsense, sensational headlines every morning. And it was Deutsche Bank, of all people. Mitch Collett upgraded the stock today. RollsRoyce and 4 other picks from a top international value investors. So, RollsRoyce is up some 60-80% over the last few months. Now everyone's starting to get it. Hasn't even started, by the way, because you're not getting the international hours from China yet. So once that kicks in, that thing's going to be a rocket. China cuts benchmark lending rates as policy easing picks up. So that's that. China plans big stimulus jolt and loser property rules as Beijing searches for stronger measures to revive the economy. So it'll come in due course, probably sooner than we expect. China hits out after the U.S. after Joe Biden calls Xi Jinping a dictator. So, you can't make this stuff up. Blinken goes over. They have a very successful meeting. They make progress. Joe Biden, has a gaffe. Not good. China didn't like it. But he walked it back today on making money with Charles Payne. They covered it. A reporter asked President Biden about his statement, and he walked the entire thing back. So I got a clip here. Let's take a listen.
I believe that, and I've said this for some time, that the hysteria about the relationship with China is collapsing and moving, et cetera. We had an incident that caused some confusion, you might say. But the Secretary Blinken had a great trip to China. I expect to be meeting with President Xi sometime in the future, in the near term, and I don't think it's had any real consequence.
And we're back. For those of you interested in politics, by the way, irrespective of what side of the spectrum you're on, I'd keep my eye on Gavin Newsom because whether you agree with his policies or not, and I think that's, well, whether you do or you don't is immaterial. He is very articulate and very, very persuasive. Whether or not you agree with his views, I would say, I was watching our president today at that press conference. You always wish people well, but the guy he did not look good. So that's the story there. Anyway, moving on to I remember seeing Gavin Newsom on Charlie Rose probably 15 years ago, and I said, I don't agree with pretty much anything this guy says, but he's the most convincing, charismatic communicator I've seen in a while. I'll give him that. The policies, it's not my cup of tea, but so that's that. Just be on the lookout for that. It really doesn't matter as it relates to. It matters, but it doesn't matter as it relates so long as the opposite party. The best thing you want with stock investing is gridlock. So whether you have a Democrat or a Republican in the executive branch, you want to pray that you have either the House or the Senate with the opposite party. And if you do, it really doesn't matter who's president. So that's what we hope for, but just keep an eye on that because anyway. So, okay, Taobao 618 live stream viewers scale up 43%. When this headline came out, people were saying, yeah, but they're not telling us about gross merchandise value. We'll have some information on that shortly. But it's interesting because Ma is back in the picture telling them what to do. And he said, go back to Taobao and focus on small businesses. And look what happened. Their live broadcast grew 43% year on year, 490 live broadcasting channels reaching 10 million views, and 66% more live broadcasters reaching 100 million views during the period. Number of master anchors surged 139%, and promotional campaign first time this year increased the number of live stream viewers by 60% year on year. That's a huge selling source. Live stream is huge in China. Why they don't think of it as like social media QVC. Amazon hasn't figured it out yet in the US, but TikTok is figuring it out, that's for sure. Merchants participating in this campaign have also seen a general spike of 2 to 3 times in sales, and we're going to see the overall gross merchandise value was actually up 14.8% for the holiday, which is pretty exciting considering how pessimistic everyone is. Also, 89 new video game licenses in June, which is interesting because that was the start of the tech crackdown with stopping all video game licenses, so that's back to a normalized level. And here's our article of the week. Something's telling me this ain't over yet. Stock market and sentiment results. Morgan Wallen's last night became the country star's first #1 on the Billboard Hot 100 Songs chart dated March 18th, 2023. The song chronicles an on-again, off-again relationship that reminds me of the stop-and-start nature of the China trade recovery since the lows in October. As it relates to China, Morgan said it best. I know you said this time you really weren't coming back again, but baby, something's telling me this ain't over yet. No way it was our last night. So opinion follows trend, as we love to say, and just as the despondency keeps knocking people out of the BABA stock, today the euphoria will keep pulling people into the BABA stock at some point in the near future at much higher levels. We'll discuss the positive developments this week in a minute. We already went through Fox. So as it relates to BABA, there were several key developments this week. First and foremost, Secretary Blinken met with President Xi Jinping. Blinken said the talks were candid and constructive, while Jinping acknowledged the two sides have also made progress and reached the agreement on some specific issues. This is very good, unquote. The talks continue with the possibility of Biden meeting Xi at the G20 in New Delhi in September. And as you saw in the clip, even Biden acknowledged we will meet in the near future. So near is probably September. Jack Ma is back in the picture at Alibaba, albeit behind the scenes. His restructuring plan is now mimicking the success seen by Mark Zuckerberg in his 230% turnaround of Meta in less than a year. You can see when he started cutting all the middle management and getting efficient, the stock turned around. That's exactly the message that Jack Ma has delivered to his lieutenants, and he's replaced many lieutenants with, he basically brought the old band back together. The people who built the company are now back in the positions of leadership. So he held a group meeting with top company executives in May per this publication called Late Post. He suggested flattening out Taobao and Tmall's organizational charts by cutting all the middle managers. This is what Zuckerberg did to turn around Meta last year. The move echoes with what's happening in Silicon Valley giants like Meta. Number 3, Jack Ma is still the #1 shareholder of Alibaba, and his position is very important to him. This week, he put 2 of his original co-founders in key roles in the company. First and foremost, most important in my view, Executive Vice Chairman Joseph Tsai, a longtime confidant of billionaire co-founder Jack Ma, will take Zhang's position as chairman of the board. Investors like him. He went to Yale. He worked in M&A. He gets it. He knows how to extract the value. And then Eddie Wu, who was also a co-founder, now chairman of Alibaba's core Taobao and Tmall online commerce divisions, will take over as chief executive of the $240 billion company. The good thing is that the new CEO and chairman are all co-founders of the company and are closest to Jack Ma. That means Jack Ma will remain the spiritual leader of Alibaba. Old Alibaba management back to the stage again. So Eddie Wu's appointment as CEO shouldn't come as a huge surprise. He co-founded Alibaba and played a key role both on technology development and monetization of Taobao and Alipay, which is the Chinese PayPal. Wall Street Journal, the shakeup could maintain the influence of Ma, who engineered the breakup of the e-commerce empire from afar while he traveled overseas for most of the year before the plan was unveiled. On Saturday, he was in his hometown of Hangzhou, where Alibaba is based, to attend an annual global mathematics competition he started in 2018 and chatted with the finalists. So he's showing up publicly. He's actively involved. This is all with the blessing of the government, or he wouldn't be there. If this was happening 2 years ago after his famous speech, he'd probably be afraid of getting arrested. The tide has shifted. The reshuffle indicates that Ma is returning, quote, to exercise more direct control, said Charlie Chai, and tech-focused analyst at research firm 86 Research. Tsai is well liked by investors, and his appointment should be seen as good news, said Wei Sing Ling, senior advisor for Asia technology stocks, blah, blah, blah. Zhang will continue to head up Alibaba's cloud computing unit, the second largest business by revenue after its domestic e-commerce unit, as the group bets on it for growth. Number 4, visible or invisible, Ma is back, and it is with the implicit blessing of the government. They need jobs and growth, and he knows how to create them. So here are pictures of him out in public parading around. This is by design. The Communist Party wants his face out there as a reminder of China's business prowess and that the game is back on. This is a clear signaling message to the rest of the world. China is back. It may take the rest of the world a little while to figure it out, but as always, opinion will follow trend. As price moves, money will move back in. He was at the company's cloud business site talking with Daniel Zhang, who steps down from the major company to run the cloud, which was expected. And in recent days, Jack Ma appeared more often in the public site. 5. Zhang will remain CEO of the cloud computing business as it pushes towards a spin-off and eventual public listing. Cloud Intelligence Group is now full speed ahead on its spin-off plans, and we are approaching a crucial stage of the process. So it is the right time for me to dedicate my full attention and time to the business, said Zhao. Zhao's intentions to only focus on the cloud have now been some years in the making. In an interview with CNBC, Zhang said cloud computing will be the company's quote-unquote main business in the future. This is what we said 2 weeks ago, how he said that he believes the baby babas will be bigger than the whole company in the near future, meaning the cloud business will be worth more than $200 billion and change. Right now, it's not ascribed anything close to that value, but it will be as it's broken up and starts to perform. 6. Jack Ma, the founder of Alibaba Group Holding, held an informal meeting with e-commerce executives in late May, advising them to refocus on Taobao. Alibaba has to, quote, go back to Taobao, go back to users, and go back to the internet, according to the report. Going back to Taobao means the platform will pivot from traffic flows to supporting marketing budgets for small and medium merchants from established brands on Tmall. Taobao, launched in 2003, was Alibaba's first consumer e-commerce platform. It achieved huge success in wooing small merchants online to defeat then rivals such as U.S. giant eBay, while Tmall, formerly known as Taobao Mall, was spun out in 2008 to fit Chinese consumer demand for brands. Alibaba employees who declined to be named as they were not authorized to speak publicly confirmed to the Post that the pivot towards small merchants has been taking place inside the business unit. For example, Alibaba has gradually scaled back subsidies on big-ticket items such as iPhones, but has increased incentives for products such as iPhone covers or ornaments, which are mainly sold by small businesses. This is huge because they're going back to what made them successful in the first place. Taobao and Tmall had a record 618 sales event this month, growing 14.8% year on year. Hat tip to Brendan Ahern. 8. U.S. dollar resumed its downtrend following the debt ceiling bid to safety, causing BABA to rebound in recent weeks. So while it doesn't feel like it, it did have a 17.5% rally in a few weeks, and now it's just checked back on this recent noise. But the trend, I believe, is upward, and this is in line with that mammoth sentiment indicator that we talked about. Once we get above this level, then it's off to the races. So we've just basically got to move. Looks like, where is this thing? Oh, that's the US dollar. So this top level here is about 120. Once we can break through that, it's going to be straight up. With owner's equivalent rent dropping off a cliff this month, June CPI to be reported in July ahead of the Fed meeting, we expect the Fed to be done and the dollar to weaken further. So this is awesome. Today, everyone looked at the 50 basis point hike by the Bank of England as a negative. We view it as a positive. Why? Because the interest rate differential is going to attract money out of the US dollar, which is stopping hiking, and into the euro, into the pound, into emerging market currencies, and that's going to weaken the dollar. And why we're so confident that we feel that the Fed is done is owner's equivalent rent. And this will be the big month. Last month, we got headline down to 4.0. We thought we would get 3.9 or 3.8, but, 1/10 of 1 basis point or whatever. But this is an important chart that shows how changes in housing prices take about 18 months to show up in the CPI through what is called owner's equivalent rent, which in turn comprises about 1/3 of the CPI. Since housing prices have now been falling for the past 18 months, the OER component of CPI will become negative in coming months, thus subtracting a major portion of upward inflation pressure in the CPI. So watch that coming to a theater near you. We're looking for a 3 handle on headline inflation in this next print before the July Fed meeting. So early July, I think it's the second Tuesday of July, we'll get the CPI numbers. And that'll be it for the Fed. And then, what we would like to see is inflation stay in the threes. We wouldn't be shocked to see inflation actually fall into the high twos headline in coming months, but threes will be sufficient. There's the US dollar. And as we can see, this can continue to weaken. Commercials are nowhere. They're not even above the midline here at neutral. Usually you don't get a bottom. So there's a lot more for this thing, commercial buyers, to come in before we got a bottom. I would think 95. You could get a situation like this, which wouldn't shock me if we're going to have a multi-year secular rally in emerging markets. But any softness and stabilization to these levels would be sufficient for what we want to accomplish. Now, Cooper Standard continues to climb on above average daily volume. Since we put it out publicly in May of 2022 and on Fox Business with Liz Clayman on June 7th, 2022, it's up 3x, or about 200% as of yesterday. We believe the move is just getting started. There's the original clip. Here's some information from our original thesis. Number 1 in sealing systems, number 2 in fuel and brake delivery systems, and number 3 in fluid transfer systems. All the companies they have, plus Tesla, which they can't publish their trademark. EVs, they get higher cost per vehicle and more parts. And this is the revenues they achieved when we were at peak production in 2017 was $3.6 billion, $456 million of EBITDA. They earned over $7 a share. They got a 20 times multiple and yet a $146 stock. We think that global production levels will reach, even if they reached 85 or 90% now with the increased margins and the costs they've taken out of the business, they can get to $7 a share. And then the question is, does it get a 10 multiple or a 20 multiple or somewhere in between? And that's our thesis for having a much higher stock. Now, you can read through all of this to get to the math of $7 a share and how we get there, which we've gone through in the past. Now, what's new and why is the stock going up again without any new earnings calls, without any new guidance, etc.? On June 14th, they published an investor presentation on their website. You can just go to Investor Relations. The stock has been moving up aggressively since then on well above average daily volume. Yesterday, for instance, it traded 373 shares compared to its average daily volume of 144,000, and it was up 6.49%. So the elephants are coming into the stock. And why are they coming in? So what's the new information? First and foremost, a reiteration, they're laser focused on return on invested capital and getting back to double-digit return on invested capital. Strong revenue growth outlook, increasing global light vehicle production, and higher content per vehicle. This is the big deal, the higher content per vehicle, which is not in our core thesis. The EVs we always saw as just a kicker. So our model is predicated on the idea that margins are what they were in 2017, and general production starts to trend up towards those levels, and they've taken a lot of costs out. What's not in our model is that the cost per vehicle is going up, their margins are going up, and they've taken a lot out of the business. So while we think $7 a share is reasonable, this thing maybe could earn $10 a share if everything goes right, and then you're looking at an even much higher stock. So it remains to be seen, but we're pretty optimistic. The value-add innovation, higher cost per vehicle, expanded total addressable market, and finally, imminent profit margin inflection, improved fixed cost structure, increased production volumes, and enhanced commercial agreements. So the EV market shift is creating new opportunities for them, greater need for optimized fluid handling architectures. So that's a big deal. Demand for differentiated sealing solutions and enhanced aesthetics, increased demand for lightweight solutions because of the battery, helping customers increase vehicle range, and generating opportunities for additional cost per vehicle. This is exciting. This is something that was not in our original thesis, which could be an additional kicker and whipped cream on top of what we think is going to be a fantastic appreciation. As you can see, they get 20% more for EVs, and the push is on globally to push towards EVs. Revolutionary integrated fluid system increasing value. This fluid system, this is huge. Up to 60% incremental cost per vehicle growth opportunity just in this one division of their business. That is like game changing. They've also used new digital tools to bring costs down. They brought down their engineering expense to sales by 109 basis points. They brought their manufacturing fixed cost to sales down 322 basis points. That's monstrous. They took out a cumulative sustainable cost saving impact to adjusted EBITDA in the last 3 years of $479 million. And at the same time, guess what's happening? North America light vehicle production is going up. And I think is very conservative, the estimates here. Improving profitability and mitigating risk with enhanced commercial agreements. Index-based agreements limiting exposure. That was a big problem for them with the inflation. Now they've got that ironed out. Improved payment terms. They would have to put up, I think they had like $85 or $100 million of tooling out there. And now they've got improved payment terms, so they don't have to have all that money tied up. And then finally is focused on profitable business, fix or exit underperforming products or regions. So they're negotiating with the OEMs to get more profitable pricing in Europe, which it was implied from the last earnings call that they're making good progress on that front, which would be a big boon. That's not in the model. So the cost savings were huge since 2018, which means when the operating leverage kicks in, the margins are going to be much higher than we have in our model. Planned revenue growth outpacing expected increases in market production. So as the market grows, 3% a year top line CAGR. Cooper Standard will grow 8% per year CAGR, which doesn't sound like a lot, but I'm going to give you the math in just a second. They now have pricing discipline, and they've got inflation recovery and sustainable price adjustments negotiated in the last year on current production business. Now, the last slide is the most important. While they have low estimated market growth, they also have, those are just industry estimates, they have conservative revenue growth for the company at 8% CAGR. Now, an 8% CAGR implies $3.15 billion of top-line revenue in 2025 and $3.4 billion in 2026. This puts us right in line for original thesis from last year of $3.3 billion of revenues, would lead to $412 million of adjusted EBITDA, $123 million of net income, or $7.19 a share in EPS. At a 10 times multiple, that's a $72 stock. At the peak multiple, that would be $46 stock. And if you want to be conservative, cut both in half, and you're still at a 5 to 10 bagger. So keep in mind, our original thesis is predicated on 2017 margins. As you can see, they've taken out meaningful costs in the last few years and increased pricing, which means our bottom line targets could be exceeded or reached earlier than expected. Time will tell. Generac and PayPal. Last week we discussed Generac and PayPal on Yahoo Finance. Thanks to Taylor Clothier, Diane Hall, and Brad Smith for having me on. We went through this last week. Since then, here's what's happened. Generac's jumped 10%, as has PayPal, up 8.5%, backed off a little today. Now on to the shorter term market. Retail got a little bit exuberant in the last couple of weeks, 42% bullish. We think this could possibly stay pinned for some time just based on the positioning going into this and the still persistent negativity. We're getting towards these ends. That's probably why you could see a grind sideways, certainly in the indices, those stocks that have kind of led the rally, maybe grinding sideways for a little bit, and some of the others coming up under the surface. And while the indices look flat, you've got a lot of good activity under the surface is our base case. And then the National Association of Active Investment Managers, still not at extremes, but backed off a little bit in the last week. So we'll see how that plays out. Earnings, top 30 weights of utilities over the last 60 days for this year came down 30 basis points. For next year is up 0.65% for earnings estimates. So 2024 going up. Same with the REITs, top 30 weights. With everyone as pessimistic as they've been, the estimates are up 0.25 basis points for this year and negative 0.64 for next year. So basically flat. And if you read the headlines, you would think the world is falling. All that needs to happen is this summer, after the trillion of issuance. You see the 10-year get bid. These things will start to fly. All right, let's go to the Ask Me Anything questions from Zach Tewinkle. How do you see Ant playing into Alibaba's return over time? Guessing China will allow Ant to go public sometimes, thanks. Yes, we've covered that many times. It was basically a year from the change of control, which was probably 3 or 4 months ago. So that'll probably go public in line with when the cloud goes public. But we did a sum of the parts analysis 2 or 3 weeks ago, and we assigned about $50 billion to Ant. That's in the short term over the next couple of years. That's the third ownership. Remember, they were going to go public for $310. They own a third. That would have been worth $1 billion, so we've cut it in half. Maybe it's a little less, but I think over time it's still going to be the largest payment system. So I think over time this is really underestimated, but in the short term it's probably about right. Next is, and by the way, the name of that article, if you want to go back and look at all the pieces, is Heads Carolina, Tails California. Stock market and sentiment results. You can either put it in the search bar here or just click on commentary and scroll back a few weeks and you'll find it. Zivko Kanazirski. Thanks again for the great video cast. I have one question, one stock. Notice that the director of V&O bought preferred shares. Would you take common or preferred shares for V&O and why? Because I want the upside. I mean, it's the same reason we took equity versus high yield debt in Cooper Standard. If you're going to take the risk, you want to have a multi-bagger. You don't want to take all the risk. I mean, if Vornado gets wiped, the preferred's going as well. So if I'm going to take the risk, I want a multi-bagger upside, and it's a complete no-brainer for me. Signet Jewelers, largest jewelry retailer in the world, has almost no competition. That's not true, but okay. They are vertically integrated, source diamonds, polish, etc. It dominates the ad space due to size. It makes it harder for smaller players. Large cash flow helps them buy smaller players. They're getting into e-commerce and services, which should help increase market share and margins. Looks attractive. Big buybacks, good capital allocation, management, own big part of the business, pretty cheap. But maybe we see further decline in sales due to cyclicality. In 2008, they lost only about 10% in sales. Also, the company is new and big position in Michael Burry's fund. Yeah, I mean, look, Buffett's had Borsheims for years. I understand the economics of the business. Let's take a look at it. It's probably okay. Signet, okay. So they continue to grow cash flow every year. They continue to grow. Earnings have been flat since 2021. Sales have been flat since 2021. So they've stopped growing for some reason. Balance sheet is pretty healthy. Generate good returns on capital. So the thing about this stock is that it's not growing right now. That doesn't mean it's not going to grow in the future. So you'd have to go on the earnings calls. But, like, this thing has recovered 10x since the pandemic lows. Like, I mean, you're probably here, okay, in the cycle. So maybe you get another, you probably can get another double. It could probably double from here. But I don't buy things after someone already got the 10x. I buy things when I'm going to get the 10x. So to take that risk for a double, I think they're just better places to put money. I think you'll probably get your double, but you're going to have to be patient because someone's already taken a lot of the meat out of the middle of this thing. And until I can see the story for future growth, how do we get to 120? I think you will. But I think there are better uses of capital for this. I think overall it's an okay pick, but I want it when no one wants it. And right now it's, a lot of people have wanted it, and there are better things to do. Raza, apologies if you've mentioned this, but I'm newer to your service. If once the Baba spin takes place, if one were to view a few of the new stocks as value investors and a few as a speculator, What would be your best guess of which to hold and which to speculate? Well, you're going to be holding all of them through the parent company because they're going to continue to hold shares and control the float for some time. The only one that you're going to get separately dividended immediately is the cloud. I would definitely hold that. I think that's going to be the big growth story. And everything else you're going to own through the parent Baba for at least the foreseeable future, even as they IPO. Kayla Smith, what are your thoughts on Zoom is? They are low debt at depressed levels. Looks like they've been hammered by retail discretionary and are near decade low prices. Recently, the CEO had an insider buy of $1 million of stock. So let's see, that is correct. He did a buy in early June at $13.57, and it was a legit buy. It wasn't him selling into a trust. It was a direct, and that's kind of interesting. Mall-based specialty retailer of action sports-related surfing, skateboarding, snowboarding, motocross, and BMX, apparel, footwear, equipment, accessories, 668 stores. So they've been pounded since 2022. Sales are deteriorating meaningfully since 2019 even. Understandable during the pandemic, then they rebounded, but then they've been really declining. So I want to understand why that's happening. Were they shutting unprofitable stores? Low return on capital, low quality business? Yeah, I see what you're looking at here from a trading standpoint. You're probably right. But you're going to have to do a lot more research into why are sales declining and what's going to turn that around. Are they shutting stores? Is their brand going out of style? How does that differ from the last, few times that the company dipped? Go back to the earnings calls and public filings, what was happening to their financials during all these periods. Without doing all of that work, I think you're probably get a decent trade out of it. This is not the type of business that I would own, but I can understand the trade. I think it's reasonable. Kayla. But go listen to a few calls. Go look at the quarterly filings and understand why this thing is deteriorating and how management says it's going to turn around. Because you can get stuck in like a GameStop and retail that's literally dying for good. Just make sure this is not one of those. Make sure it's closer to a Lulu or an Apple than a Bed Bath & Beyond. All right, Jason Zen, fairly new to your content. Bob introduced me to your content. Stanley Druckenmiller recently went on Bloomberg to discuss his views on China, and he thinks the risks are high, but did concede it might boom short-term due to their stimulus activities. What do you need to see economically or politically in order to reevaluate your tolerance for China risk? Nothing. I size it according to my ability to tolerate risk. Every position I go into under the assumption it could be a zero. And as long as I wouldn't be taken out on a stretcher on that basis, that's the right sizing. And for my money, there's no better value in the market than the Chinese equities. What would change my mind if I saw material deterioration, not in headlines and nonsense and political gaffes and BS, but actually rather than Tmall and Taobao being up 14.8% year on year, it was down 14.8% year on year. Rather than cash flow growing, cash flow was declining. Whether their cash balances increasing, they were decreasing. Rather than buying back shares, they were issuing shares at low prices. All of those are things that would change my mind, but all of them are going in the exact opposite direction. The businesses are growing, the cash is growing, the buybacks are growing, management is taking the right actions, making the right changes, doing shareholder-friendly value unlocks. So that's where we are. We'll see. Hey, Tom. Love the family updates and weekly videocast. Question about the large amounts of insider selling versus insider buying recently. I'm looking through FinViz top insider transactions. Is there something you've noticed? What would be your take on that? Thank you as always. That's always that way. So people sell for a multitude of reasons. Most of the selling is planned 503B or whatever they call those planned sale things for management because they're constantly reissued new options. So they do it some cases to pay the taxes, some cases to have a regular sales program, some cases just because they want money. Those aren't indicative. If you look at the empirical data and the research publications from decades, sales don't say a lot, but buys do. People sell for a multitude of reasons, but they only buy for one reason when they write checks, which is why that thing that Kayla mentioned is somewhat interesting and worth pursuing further with research for her. Matthias Becker. Dear Tom, I'm a happy viewer. By the way, we've seen massive buying in banks. Has been the biggest insider buying in the last few weeks. So that could be indicative of a place to be paying attention. Matthias Becker. Dear Tom, I'm a happy viewer and recommender of your weekly quote-unquote academy. It's education that reaches far beyond the question of which stock to buy, and it helps me to make sense of the world during difficult times. Before it sounds religious, just a big thank you for this valuable compass. I recently heard of enterprise value per sales. Is that a metric that provides value to me, to you? Okay, so not really. And the reason is because you can't spend sales, you can only spend profits. So metrics on the basis of sales aren't really useful. I'm most interested in cash flow. As a German, I'm wondering about the DAX index. It recently reached all-time highs. Did I miss something? And Germany has a golden times ahead, considering that the stock market always prices in the future. Very thankful. Speaking of your recommendations, your VideoCast was recommended to me by YouTube, so their algorithm deserves a thank you also. Oh, that's cool. Germany will trade with China. Europe is a lot more dependent on the success of China than the U.S. is. So on that basis, I would say Germany's probably going to be okay. It's not an area that I focus in or specialized in. But if I had to be ex-U.S., I would be in China before I was in Germany. And Germany may have priced in a lot of good news that I think there's better upside in other pockets. If I have to be in Europe, I'm looking at value in the UK, which is the most hated. Germany's already kind of had a run. They'll probably continue to persist higher, but I like to look when people absolutely don't want it, so I'm getting the biggest margin of safety right now. Germany has moved a lot, so that's that. Daniel Hussein, what are your thoughts on Paylocity, PCTY, a cloud-based human capital management company? All right, let's take a look at that. PCTY. Okay, so this stock is up 20x in 8 years. For me, it's just not what I do. I don't buy things that are up. I buy them when they're out of favor. This is not really out of favor. Yes, it's checked back a little bit, but let's see what the business is doing. Maybe I'm going to be educated here today. Gross margins come off a little bit, but was growing. Free cash flow continues to grow. Return on capital and equity is spotty. Let's see. PCTY. Revenue's growing. Operating margins. So earn $2 and it's trading at 180. So it's trading at 90 times earnings. Generating a decent amount of cash. Compounding capital. I mean, it looks like a good growing business. It's just, it's trading rich for me. I mean, it's not what I do. This could probably work. I'd want to understand how, what's the moat that's going to enable them to continue to grow? Who are the competitors? How does this go wrong? Because at, up 20x, I certainly think that some things can go wrong. But do your work. Understand, why is it down? Why is it off, not 50%, but 40%? And what's its competitive advantage? What do they have that no one else can replicate to erode their margins and erode their growth? It does look like, a rocket ship. This is just simply not the type of thing that I do. I mean, I'm guessing on whether their mode is going to be retained, and at 90x, I don't have much of margin of safety. I got to be right, because if I'm 1% wrong, the stock could drop another 50%. So, I'm a pass, but do some more research, listen to the calls, understand the business, look at the sell side, look at the bear thesis, look at some of the bull theses, and go from there. But it can work for you, but it's not going to work for me because we're not going to be involved. So with that said, I want to thank everyone for tuning in. We're going to be back next week, same time, same place. In the meantime, make it a great one. Bye for now.